The move already happened. While everyone was distracted by sideways price action, XRP was being absorbed. No breakout, no headline, no dramatic green candle to chase, just silence. That's what made it dangerous. I was staring at the chart around 2:47 a.m. when I noticed something strange. The candles looked lifeless, tight ranges, low volatility, almost boring. Social media engagement was down. Influencers had moved on to louder coins. Retail interest was fading, but the order books were telling a different story. Every dip instantly bought, every small sell wall quietly chewed through. No excitement, no euphoria, just systematic absorption. And then I checked the on-chain data. Exchange balances were shrinking. Large wallet clusters were increasing positions in steady, structured increments, not market buys, but layered bids. The kind of behavior you only see when capital doesn't want attention. This wasn't hype accumulation, this was silent accumulation. The kind that happens before narrative flips. The kind that leaves retail staring at a breakout candle, wondering why they didn't see it coming. And the more I dug, the clearer it became. This wasn't random consolidation, it was positioning. Let me show you what almost nobody noticed. Most people misunderstand consolidation. They think nothing is happening. But I've learned the most important positioning happens when price looks dead. XRP had been grinding in a tight range for days, volatility compressed, funding rates neutral, liquidations minimal, retail engagement declining. You could feel the boredom in the market, and boredom is a weapon because retail doesn't accumulate in boredom. Retail chases movement. When there's no excitement, capital rotates elsewhere. Attention shifts to trending narratives. That's when liquidity thins out, and thin liquidity is easier to control. I watched the microstructure carefully. Instead of aggressive buying pushing price up, there were layered limit orders sitting just below market price. Every small flush was absorbed instantly, but price wasn't allowed to run. That's not weak demand, that's controlled demand. If buyers wanted momentum, they'd lift offers aggressively. Instead, they were letting sellers come to them. Patient, disciplined, invisible. And that tells me one thing: whoever was accumulating didn't want the market to notice, because the moment retail notices, the price isn't cheap anymore. Then I checked the flows. Exchange wallets were bleeding XRP. Not dramatically, but steadily. A slow drain, the kind that doesn't trigger headlines. When tokens leave exchanges, they're usually going into cold storage or long-term custody. That means intent to hold. And here's what stood out. The withdrawals weren't fragmented retail-sized transactions. They were structured, large round numbers, clean increments. The type of movements you see when funds rebalance or institutions allocate. Now, if fear was dominant, we'd see inflows, tokens moving onto exchanges to sell. Instead, supply was quietly disappearing. That creates something most traders underestimate: future scarcity. Because price doesn't move when buying happens. It moves when selling dries up, and when supply is removed from exchanges during low volatility, it sets the stage for explosive imbalance later. Most people were watching the candle bodies. I was watching the reserves, and the reserves were whispering accumulation. There were no flashy announcements, no new partnership hype, no dramatic legal shift from the U.S. Securities and Exchange Commission. And that's exactly why it worked. When there's no narrative, price becomes invisible. But beneath the silence, regulatory overhang has been gradually thinning. Court clarity, procedural narrowing, reduced uncertainty, not loud enough for headlines, but significant enough for long-term capital. Institutions don't wait for the final press release, they front-run probability. If risk decreases quietly while retail attention drifts away, that's the ideal accumulation window. I noticed something else. Major media outlets weren't bearish. They were indifferent. Indifference is more dangerous than fear because it kills scrutiny. No one questions sideways price action. No one investigates low volatility. And that's when positioning happens most efficiently, not in chaos, not in hype, in silence. I spent hours watching depth charts. Sell walls would appear, modest psychological barriers designed to keep price capped. But they weren't defended aggressively. They were there to slow momentum. Meanwhile, bids stacked quietly underneath. Not spoofing, real size. When price dipped even slightly, the absorption was immediate. No slippage, no panic, just calm execution. That's how accumulation desks operate when they don't want volatility. They suppress breakout attempts to keep price in range while collecting supply. If XRP truly lacked demand, dips would extend. They didn't. Every red candle was short-lived. Every flush was shallow. That's not weakness. That's controlled compression. And compression, when sustained long enough, becomes pressure. Pressure that eventually resolves violently, but only after accumulation is complete. While XRP moved sideways, other coins pumped, meme coins spiked, AI narratives trended. Traders chased volatility elsewhere. I saw it in engagement metrics. XRP search volume dipped, social chatter declined. That's when I knew accumulation could continue undetected. Retail psychology needs stimulation. When a chart looks flat, conviction fades. Holders question opportunity cost. Some rotate out. That rotation feeds supply into patient bids. It's a transfer from impatient capital to strategic capital. And here's the uncomfortable truth. Markets are designed to exhaust you before they reward you. Sideways price action isn't random, it's psychological pressure. It tests whether you need excitement or whether you understand structure. And most fail that test. Institutions operate on asymmetry. They don't buy when certainty is obvious. They buy when probability shifts quietly in their favor. Regulatory risk surrounding XRP has been gradually stabilizing. Each legal development reduces tail risk slightly. Not enough for celebration, enough for modeling. If you're managing large capital, you accumulate during volatility compression, not during breakout confirmation, because breakouts cost more. The absence of aggressive downside despite negative sentiment suggests something important. Downside liquidity is drying up, and when downside liquidity dries up, price doesn't drift lower, it snaps higher. I've seen this pattern before. Silence, compression, exchange outflows, then ignition. And ignition rarely gives you time to think. Right now, XRP looks boring. That's the opportunity. Volatility is compressed, supply is thinning, sentiment is neutral to skeptical. That combination is explosive. If a catalyst emerges, regulatory clarity, institutional product launch, ETF-related momentum across the broader market, price won't crawl upward. It will gap, because the supply that used to sit on exchanges isn't there anymore. It's in cold storage, in stronger hands, and when demand meets reduced supply, markets don't move politely. They reprice violently. Here's the insight most people miss. You won't get a notification when accumulation is complete. You'll get a breakout candle, and by then, risk to reward has changed. Silent accumulation phases are uncomfortable. They test patience, they create doubt, they look like stagnation, but they are often the foundation of major moves. If you only pay attention when XRP trends on social media, you're late. If you only buy when green candles confirm safety, you're exit liquidity. The market doesn't announce opportunity, it disguises it as boredom. And right now, XRP is quiet. Too quiet. That doesn't guarantee a reversal, but it does signal positioning. And in markets, positioning always precedes narrative. The question isn't whether a move is coming, the question is whether you'll recognize it before everyone else does.